Hey everybody, Finance Farmer, and today I have a very exciting video, and that's how to sell covered calls. This strategy I've used for the past 3 years to generate a pretty good amount of income inside of my portfolio. So let's get into it. In this video, I'm actually going to show you step by step how to sell a covered call. We're going to go through it together in the brokerage account and sell one together. I'm going to show you some examples, and then I'm going to show you my results / recommendations. But as always, I'm just a guy on YouTube. This is not financial advice, it's just educational. So what is selling a covered call? Selling a covered call means that you are obligating yourself to be willing to sell your shares at a certain price above where it is right now. And you get to decide what that price is and on what time frame. In order to get started, you're going to need 100 shares of a stock or ETF that you want to sell this covered call on. That's what puts the covered in the covered call. So let's say you own 100 shares of your favorite stock and you want to sell this stock, or would be okay with selling this stock at $5 more than what it's currently at 1 month from now. In this example, you would find the strike price that was $55. So it's $5 above the current price of $50 a share. In exchange, you would receive $100 in premium for selling that contract. So there are two concrete outcomes after you sell a covered call. And the first one is that the shares are below the strike price. So at expiration, let's say 30 days from now, the shares are at $53. The strike price you sold the covered call at was $55. That means you just get to keep the shares and you just get to keep the premium. At that point, you have no obligation to sell those shares at any price. The second outcome is at expiration, the stock is higher than your strike price of $55. So let's say in this case, it ends at $57. That means you're going to have to sell your shares at $55 no matter what. So still, that's a $600 gain. You got $100 in premium, plus the shares are worth $5 more per share times 100. So at the end of the day, you're still making money, but you definitely capped your upside. And that leads me to the biggest risk, and that actually is capping your upside. The market tends to go up, and you're going to be making a little bit of money from selling a covered call, but you could be leaving a lot on the table if the stock rips. So just something to keep in mind and for you to explore when you're on the options chain. All right, now that you know the mechanics on what a covered call is, let's go and head into the brokerage and sell one together, and I'll show you step by step what to do. All right, we are inside of Robinhood. So I'm at VGT. I just have that pulled up. And as you can see, I have 230 shares, which is more than 100. And that's the minimum required to do a covered call. I'm going to go to trade options. Robinhood has covered calls here, but you can go to the options tree and I'll just select September 18th. And September 18th is going to be the expiration date. And you can see all these numbers on the left side. That's going to be the strike price. So those are the numbers I'm agreeing that I'm going to sell my shares at. If they go higher than that. Remember the if. If not, I just keep the premium. So I'm going to do 128. So I'm going to tap on that. It's at a 90% profit. I'm going to hit sell. And this brings me to the limit order screen. And you can usually choose something in between the bid and the ask here. So I'm going to do 0.50, which is $50 in credit. Then you hit review and you swipe up. So when market opens, hopefully this order goes through and I'll get $50 in cash right then and there. Selling covered calls to me is part of a bigger strategy, and I like setting the strike price really high. I don't want my shares called away. I want to grow and compound my positions and wealth over the long term. And I do like collecting a little bit of premium along the way. And I think this is a great option for that if you're willing to not think about getting a ton of premium every single time. I like holding quality companies and stocks and waiting it out and making a little bit of extra income on the side. And it's worked out to be 1% or 2% every year for me on top of my compounded annual growth. The other time I could see covered calls being really useful to somebody is if they own a large position and they want to trim down and they're in no rush. They want to make a little bit of money. They can set that strike price closer to where the stock is trading right now. Hey, this might be a good strategy for you. If you learned something, please leave a like, please subscribe, stay happy, stay growing, and I'll see you on the next one.